Floor show to game it all out from the investment perspective. Joining us now, JP Morgan Asset Management Global Market Strategist Meera Pandit and Creative Planning President and CEO Peter Mallouk. Meera, you get this first one. Give me your gut feeling when you heard everything that Jay Powell said and how it pertains to your clients and their reach for yield, their look to see growth in their portfolio.
When I think about what Powell said and how the markets reacted today, I'm actually looking more at the projections than anything else, because we know, given this new unknown risk around the Middle East and the higher oil prices, that headline inflation is going to move higher. But those projections made a point that also there is some risk around core inflation and core goods. Therefore, we do need to be mindful that rates may stay slightly higher for longer, cuts may be few and far between this year, if at all.
Do you agree with that?
I do, because ultimately, if inflation, as Chair Powell acknowledged, has been above target for a period of time, if, as Nathan acknowledged, the economy has had decent momentum, then perhaps we don't need that many cuts yet. The key will be how much the labor market does stay intact. And it is in this very tenuous equilibrium. I mean, being in an environment, as Powell acknowledged, of zero job creation is a little bit challenging and may warrant another cut just to give us a little bit of insurance. But overall, we have to think about this higher inflationary environment and whether inflation expectations do move higher, although they've been reasonably well anchored for now.
I would be shocked. Zero job creation. Peter Mallouk, I do my own little, on the ground research when I'm out and about. I was in a restaurant the other night in the middle of Manhattan. It was kind of late. Oh, I was up after school hours. And it was jam-packed. Granted, that's Manhattan. People go out. But what is your perspective here, and what's the trade, no matter what the standard economic projections were today?
Well, I just don't see how we're not going to continue to have high inflation. You've got deficit spending of $1 trillion every 5 months. We're going to pass $40 trillion in debt. We've been over inflation projections for almost 6 years now. I mean, there's nothing that says we should have a rate cut other than political pressure and a really negative surprise from a jobs perspective. And I think what you're seeing in those restaurants is the reason you have the mayor you have, whether you love him or hate him. It's that if it's going to cost $30 to buy a sandwich, a lot of people, that doesn't work. And so the K-shaped recovery is real. It's getting worse. You see it with luxury hotels doing better than ever, but economy hotels doing worse than ever, and luxury restaurants doing great, and lower end restaurants doing poorly. And I think that's the world that we're living in right now. And inflation hits the majority of Americans much harder than it does the asset owners that are mostly watching your show.
The K-shaped economy, right? We reference this all the time, folks. The upper stick of the K, that's the higher end consumer, the wealthier person. The lower end, look, all the numbers bear out that the lower end is not doing that well. Meera, let's just say, no matter who's watching on the piece of the K there, they all understand that investing in the right things at the right time can make you a lot of money. So what are you advising?
When I think about this year, I think it's going to be a huge tension between fundamentals and sentiment. And when you look at the fundamentals, earnings growth is still strong, whether it's the Mag 7 growing 20+% earnings growth for the year, or the rest of the index as a whole also expected to grow double digits. The fact that valuations have actually come down slightly and stagnated, and a lot of the growth across the world in the equity market is actually seeing multiples compress while equity returns are being driven up by earnings growth. So the fundamental backdrop here, not only in the U.S., but in many different economies, is still decent from a stock market perspective.
Tell me what to buy.
If I think about U.S. equities, we have seen this shift from growth to value, and certainly some of these value-oriented sectors are having double-digit returns so far this year, or high single-digit returns. So if we think about this AI trade, it's diversifying from the big spenders to the recipients of that spending. So think industrials, utilities, materials, all benefiting from that end of the spectrum. If we think about globally, certainly AI in different parts of the world, whether it's Taiwan, Korea, continuing to see upward pressure that's helping out profitability. And then we think about fiscal spend. While there may continue to be some challenges in Europe related to the Middle East, and potentially Japan as well, you're still seeing that fiscal thrust there that is a multi-year story. So we're finding more opportunities in the market than we certainly did in 2023 and 2024, when there were just a few stocks that were doing well. Now you see much broader opportunity set and huge single stock dispersion and volatility, creating opportunities underneath the surface.
Peter, really quick, your favorite opportunities?
Yeah, I think I agree. I'm very bullish over the long run, but I think AI is really going to compress multiples for a lot of tech companies. I like large cap US, small cap US, even though small cap got hit today, it's priced in the interest rate cuts. Stay diversified. AI creates too much uncertainty, even 10 times more than the war.
All right. We got some uncertainty with the markets here. Look at the Dow down 752 points. Meera, Peter, again, great to have you here. Your perspective is very helpful to the viewers. Thank you so much.